Yep. Ladies and gentlemen, thank you for standing by, and welcome to the GEA Group Full Year 2019 conference call. At this time, all participants are in listen-only mode. After the speaker presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 1 on your telephone. Also, must advise that the call is being recorded today, Tuesday, the 17th of March, 2020. And without any further delay, I would now like to hand over the call to your first speaker today, Oliver Luckenbach. Thank you. Please go ahead.
Yeah, thank you very much, Ramon. Good afternoon, ladies and gentlemen, and thanks for joining us today for our full year and Q4 2019 conference call. My name is Oliver Luckenbach, and I'm the new head of investor relations at GEA. I joined 2 weeks ago, and I am, together with my team, very much looking forward to having a very successful relationship with you. With me on the call today are Stefan Klebert, our CEO, and Markus Ketter, our CFO. Stefan will begin today's call with the highlights in 2019, and Markus will then cover the financials before Stefan takes over again for the Outlook 2020 and our key priorities. Afterwards, we open up the call for the Q&A session. I would like to start the call today by drawing your attention to the cautionary language that is included in our safe harbor statement as in the material that we have distributed today. And with that, I will hand it over to you, Stefan. The floor is yours.
Thank you very much, Oliver, and good afternoon to everybody on the call. It's my pleasure to welcome you to our conference call today. Before I share our view on COVID-19 with you, a topic that is, of course, top of mind of all of us and its impact on our business later in the Outlook section, let me start with our performance in 2019. I'm very pleased to say that 2019 was a year of strong progress for us, and we have delivered what we promised. First, we have implemented a new organization structure and set up a new management team. We have given the P&L responsibility to the divisions team, as we believe to take it away from them was the main reason for the margin decline in the past. Second, we have accelerated our restructuring process and reduced the number of FTEs by 400, half of the total number expected by the end of 2020. Third, we have achieved or even exceeded all financial targets. That makes us confident that we are on track to restore credibility in the capital markets. However, we know that there are many more steps to come. Fourth, we have set ourselves midterm targets for 2022, and we confirm them today despite the temporary challenges posed by the coronavirus outbreak. Because we remain fully confident about the future growth prospects of GEA, thanks to its healthy fundamentals and its strong positioning within an attractive and generally growing industry. And we will talk about this in more detail later to give you even more confidence in our markets. Fifth, we are on track with our portfolio pruning. End of November, we sold the Klebert Engineering, and we are expecting more disposals to follow. All in all, I can say that we have set the grounds for a long-term successful development of the GEA Group. Let me now come to chart 5. I am pleased to say that we have slightly exceeded our sales and ROCE targets. Sales grew by 1.1% to 4.9 billion euro, versus the initial guidance of a moderate decline, and ROCE came in at 10.6%, slightly north of our forecasted range of 8.5 to 10.5%. Our operating result, EBITDA, before restructuring measures, reached 479 million euro and was at the upper end of the guided range of 450 to 490 million euro. Please keep in mind that this number includes around 40 million euro of negative non-recurring special charges. This very good performance, in combination with our strong free cash flow generation, was the basis for our decision to propose an unchanged dividend of 85 euro cents per share. On chart 6, I want to share some more information on full year 2019 with you. Let me focus on some key developments. Order intake increased by 0.3% to 4.93 billion euro and reached a new record level. Book-to-bill ratio stood at 1.01. Sales growth of 1.1% was driven by a strong services business, while new machine sales had a compensating effect. EBITDA before restructuring measures I just talked about on the former slide, so let me come to net income or net loss. Net loss amounted 171 million euro, mainly as a result of higher restructuring charges and the goodwill impairment on our subsidiary Pavan. With that, I hand it over to Markus to give you more details on the financial numbers.
Thank you, Stefan. Also a warm welcome from my side. Let's continue on page 8 with some more details on order intake, sales and book-to-bill ratio. Order intake in Q4 2019 increased by 9% to 1.34 billion, which represents a new record volume in the fourth quarter. The growth came from business area equipment, where base and medium-sized orders were higher than in Q4 2018. Also, order intake at business area solutions developed nicely. Here the driver were large orders. Sales declined by 2.4%, while service sales continued to grow. New machine sales were down by 4.6% year-over-year. The weakness of new machine sales came from both business areas. At business area equipment, mostly dairy farming with difficult market conditions in the US were the reason. At business area solutions, new machines were almost flat. Strong growth in beverage and utilities was compensated by negative impact in food, chemical and pharma. Service sales grew by 2.5%, with business area solutions growing a bit stronger, as price increases at business area solutions were carried out a bit later during the year. To sum it up, order intake was very solid in Q4 2019. Growth was driven by the service business, while new machine sales growth was weak. Now I'd like to draw your attention to page 9, the development of our service business in Q4 2019. Service business grew by 2.5% to a new record level. In the quarter, service sales accounted for 32.7% of total sales, which compares to 31.1% in the last year's reported period. As in the prior quarters, pricing contributed to the sales growth. In Q4 2019, the effect from pricing was around 2.5%. To sum it up, our high-margin service business continued to grow. Let's go to page 10 with EBITDA, EBIT and ROCE. As you are well aware of, from 2019 onwards, IFRS 16 is in effect and impacting EBITDA and EBIT. In Q4, EBITDA came to 150 million euros, down from 157 million last year. As in the prior quarter, there were the following effects. First, in Q4 19, we had a positive IFRS 16 effect of 18 million, which did not exist in Q4 2018. Second, we had a headwind of special effects of 16 million net expenses. These two effects in net was only 2 million euros. EBIT declined from 97 to 93 million euros. The decline was not as pronounced as on EBITDA level. This is mainly due to expiring purchase price allocation expenses on a year-over-year basis. ROCE started to slightly improve quarter-over-quarter. The year-over-year development is still down due to a decrease in last 12-month EBIT, an increase in last 4 quarters capital employed figure, and the phasing in of IFRS 16 rights of use assets. To sum it up, EBITDA and EBIT were year-over-year lower due to a very strong Q4 2018. ROC was lower year-over-year, but slightly improved quarter-over-quarter. Please follow me now on page 11 to the full year EBITDA bridge. Our starting point here is 539 million euros and is calculated from the old definition as follows. Starting at an operating EBITDA of 518 million euros for 2018, one deducts 42 million strategic project cost and adds back 67 million IFRS 16 impact, as well as 5 million carry down on inventory. This brings us then to the number 472, 67, and in total 439. Volume contributed positively in 2019 with 27 million euros. While new machines contributed 43 million negatively, our service business with 53 million euros positive overcompensated that effect. Also margin-wise, the service business was the clear driver. The development at Business Area Solutions with new machines contributing negatively by 17 million euros has to be seen on the back of the cost of 21 million euros associated with the backlog review we conducted in 2019. Without this effect, the margin development would have been positive. Regarding R&D expenses, the driver here were the increasing personnel expenses. Same also counts for SG&A. Personnel expenses increased by 44 million and were only partly compensated by cost reductions in other SG&A costs. This shows the necessity of our program to reduce the headcount by 800 FTE in total. FX was a tailwind in the entire fiscal year, predominantly from movements of the US dollar. This in total brings us to an EBITDA of 479 million. To sum it up, in 2019, eliminating our special items of 41 million expenses and 20 million of FX gains, our pro forma EBITDA was 501 million. Additionally, one needs to consider positive special effects of 23 million in the year 2018. Thus, operationally, the gap was only 15 million euros year-over-year. Let's proceed on page 12 to the net working capital development year-over-year. Net working capital improved by 65 million year-over-year, and the ratio stands now at 14.0%, down 155 basis points. Net working capital at Business Area Equipment reached now 621 million euros, while it was 86 million euros at Business Area Solutions. The year-over-year improvement was mainly a result of the following factors. Net trade and POC receivables declined by 19 and 27 million respectively. Trade payables increased by 18 million euros. Inventories remained flat year-over-year. We are now already at the upper end of the targeted range for our net working capital ratio. Does this mean that we are done with our aimed net working capital improvement? Certainly not. The reduction in net working capital is one of our top priorities, as we have outlined in the last conference call. You will see further improvements already this year. However, there will be seasonal fluctuations between the quarters. To sum it up, reaching 14% net working capital over sales already at the end of 2019 shows our capability to reduce net working capital. Coming from net working capital to cash flow on the next slide. Starting from an EBITDA of 150 million euros. The improvement of net working capital in Q4 2019 contributed 250 million euros in cash. The improvement came from a reduction of inventories by 168 million, as well as an increase in payables by 132 million euros. Receivables increased, however, by just 51 million euros. Cash out for restructuring was 30 million euros and resulted from the initiatives which were announced and implemented earlier in 2019. The category Others was positive by 50 million and included pension-related cash outflows of 9 million euros and add-backs from the net effect of divestments of 16 million euros. This gets us to an operating cash flow of 372 million euros. CapEx of 59 million euros is about the same level of last year, and with other cash, this led to a free cash flow in Q4 2019 of 308 million euros. Taking into account lease payments according to IFRS 16 of 16 million euros and interest payments of 5 million euros, our self-defined net cash flow came to plus 287 million euros. A result of the positive net cash flow development, net financial debt of 263 million euros at the end of Q3 reversed to a net cash position of 28 million euros at the end of Q4. To sum it up, free cash flow came in strong with 308 million euros. We were able to close the year with a net cash position of 28 million euros. Both results are driven by an improvement of our net working capital. Coming now to financing and liquidity on page 14. As always, starting on the left side of the slide, GEA is solidly funded on a diversified financing structure. The numbers have slightly changed compared to Q3 2019. The solid cash generation in the fourth quarter has led to a lower utilization of the bilateral credit lines by 167 million quarter-over-quarter. Please follow me now to the right side of the slide. The decline of the equity position is predominantly explained by a negative net income of 171 million euros caused by higher restructuring costs and the goodwill impairment at Pavan of 248 million euros. The rating leverage stands at 2.9 times according to Moody's consideration at the end of September 2019 and has deteriorated compared to Q4 2018, but improved sequentially from 3.1 times according to Moody's consideration as of June 2019. The financial headroom in long-term financing instruments and the net cash position are providing sufficient comfort in terms of liquidity. We are committed to our investment grade rating, and our clear target is to maintain this going forward. Thus, there is currently very limited headroom for further leverage. To sum it up, GEA remains in a solid financial situation regarding its financing structure and liquidity. And now back to Stefan.
Thank you very much, Markus. So we continue on page 16. And to set the frame, I want to share our current view on COVID-19 situation with you. While the situation in China apparently eased, we anticipate further impacts in other regions, especially in Europe and also in the US. It is hard to reasonably forecast how the direct and indirect economic impact is going to be. However, we anticipate certain effects on global supply chains and workforces. Coming to the current situation at GEA, after we have been affected by the official shutdown of entire regions in China, all sites resumed to work as per government permissions. Since then, all our sites are running. So far, we have not yet experienced any significant impact on our supply chain, but we already put mitigation efforts in place. However, it is clearly getting more difficult for our service staff to visit customers due to certain travel restrictions. The guidance I will talk about in a minute reflects our best guess as of last Thursday. I want to finish this chart by saying that we have put in place a global task force to react adequately. The team assesses the situation on a daily basis, even at weekends, develops mitigation actions, and ensures the health and safety of our employees, which remains the company's number one priority. In addition, we implemented a number of measures, including travel restrictions. We will continue to provide close guidance to employees and take all appropriate steps to protect them as the situation develops. While I'm not in a position to tell you when we will back to normal, I am pretty sure that this situation will be temporary. Now I would like to turn to our outlook, which reflects the current situation I have just talked about. In a normal environment, of course, we would have expected sales to be slightly above the 4.9 billion we have achieved in 2019. However, assuming a certain impact of COVID-19, we guide for a slight decline in sales for 2020. Despite this expected lower sales number, we are confident to be able to achieve an EBITDA before restructuring measures in the range of 430 to 480 million for the following reasons. First, last year we had non-recurring special effects of around 40 million euro, which we do not expect to repeat to the same extent this year. Second, we expect to benefit from an increase in operational efficiency driven by the release of further FTEs. And third, we assume a positive contribution from our new global procurement and supply chain organization. It replaces the three formerly independent purchasing organizations we had so far. Lastly, ROCE is expected to be in a range between 9 and 11%. Before I close with our roadmap for this year, let me focus on our key priorities for 2020. First and foremost, we will and we have to manage the impact of COVID-19 internally and on our operations. Second, we will push to realize the savings from the new global procurement and supply chain organization. Third, we will reduce our workforce by another 400 FTEs like announced. In total, 800 employees by the end of 2020. On a full year basis, that will be around 600 FTEs. And fourth, we will continue to increase our operational efficiency. Fifth, we will divest earmarked low-margin businesses to focus our efforts on the remaining operations. So we are very confident that achieving these key priorities will be another step to further restore credibility of capital markets into the GEA Group. Let me finish with our roadmap for 2020. I want to highlight our divisional strategy day end of June in London. You can expect a deep dive into our 5 new divisions, giving you the opportunity to learn more about our business and to get more detailed information about our actions and targets for these divisions. With that, I hand it back to Oliver for the Q&A session. Thank you.
Yeah, thank you very much, Stefan and Markus, for the prepared remarks. We will now start the Q&A, and operator, please open the line.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Again, as a reminder, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. And if you wish to cancel your request, please press the hash key. Once again, star 1 if you wish to ask a question. So our first question is from the line of Claes Bergenlind. Thank you. Please ask your question.
Yes. Hi, Stefan and Markus. It's Claes from Citi. So a couple from me, please. First of all, in your guidance of a slight revenue decline this year, how much of this is protected by the backlog in solutions versus in for out in equipment? Equipment is obviously much shorter lead times. I'm interested in your lower end scenario, 430 million, Stefan. If orders now nosedive from March onwards, to me it feels difficult to achieve your lower end. So I will start there.
Klaus, hi. Good to have you on board here. At BA Equipment, we are looking at end of December at an order backlog here of 770 million. And when looking at solutions, we're looking at a backlog of 1.7 billion out there.
Okay. So 770 million is for invoicing and equipment. And is that roughly, should we expect like a 6-month lead time of that backlog to be invoiced? Is to understand, Marcus, a little bit the duration of the shorter backlog, if you like.
Yes, up to 6 months.
All right. Good. Then my second one is on on your savings of 25 million for 2020. I get this. If I back out the 25 million and if I assume that revenues will fall slightly, which I think in GEA's language is 3%, then I get the operational gearing underlying to be around 34%. But I know that there are many moving parts. There are one-offs that are reversing and so on. But the 34% is not that different versus your gross margin. So shall we assume that you haven't baked in any price pressure in your guidance at this stage, thinking more now about the second half rather than the first half?
Klaus, we have not baked in any price pressure here on our sales figures yet. Will there be any price pressure? Well, we see actually the biggest challenge perhaps more on the service side than on the equipment side and price pressure, because it's always a question if we can get to site of our customers, and there actually would be probably more potential challenge here with the coronavirus than currently what we see from our order intake and the negotiations which are taking place.
And how many? So typically, I think when we met back in November, you and I, we were talking about that. Obviously, the majority of the service business today is still spare parts. So could you help us, Marcus, in terms of how much is service contract? So we could obviously basically model that it could be delays both on volume and price from people not being able to travel, etc.
So when looking here at our service figures, it's about 50% is spare parts, but of course they need to be built in. So it's not just selling them over the counter. Usually, we have to implement them in the machinery and equipment there, and then service contracts is around 20% below that.
Okay, good. And then I just had one quick one. Could we talk about the 25 million here? This is from previous announcements. How much is procurement and supply chain versus the tail end of the 800 FTEs coming through? We know that 400 people have left. And just trying to understand the 25 million better and whether there is any upside to this.
Our assumption for this year is that we're going to have a full year effect of 600 FTEs in 2020.
Yeah.
And there, of course, there's some upside if we are able to release more in the first half of the year. But I think that's a pretty fair assumption when we say it's a 400 by the end of last year and another 400 this year to say there's a 200 FTE full year effect.
Okay, cool. Very quick one, promise, last one. The footprint in Europe, could you help us with where you are more exposed other than Germany and Italy? So where exactly is your footprint? We're getting a lot of questions. If we see, we're seeing France closing, Italy has obviously closed down. The manufacturing, the blue-collar exposure, I don't know if you could rank them by country, talk a little bit more about your exposure in Europe.
Stefan is speaking here. So our biggest number of blue-collar workers is, of course, in Germany by far. We have operations in Denmark, in Netherlands, in France, and also in Italy. But I can tell you that even the situation in Italy is very, very dramatic in terms of COVID-19. All our factories are still working fully operational.
All right, thank you.
Thanks, Klaus.
Next question is from the line of Lucie Carrier. Thank you. Please ask your question.
Hi, good afternoon, gentlemen. I have a couple of questions. I will go one at a time. The first one actually was around the dividend, and maybe if you could give us some indication in terms of your statuses regarding AGM and if we are potentially facing a risk of any delay considering what we see on COVID-19. The reason why I'm asking is because we are seeing several announcements at this time on that front, and it would be great for us to understand what you have in mind or what is possible within your article of association.
So we have not made a final decision yet to postpone it, so it's still on for April 30th, our AGM. We are monitoring closely actually the situation here in Germany, if it is advisable for our shareholders and for our employees to leave it on there. So then further, actually, no, we have not contemplated internally any dividend cut.
Okay, and do you have?
A question?
Sorry, can you hear me? Hello.
So did I answer your question? I thought your question was if we postpone the AGM. We have no plans postponing the AGM. However, that is, of course, a possibility if the situation in Germany deteriorates and it's not possible to do an AGM due to new regulations. Then, of course, we are as I said, we are monitoring that closely.
Right. Okay, thank you very much. Just to confirm also what you were telling earlier to Klaus. You're saying all of your factories in Italy are currently running. Is it the case also across Europe, despite what are hearing in terms of confinement measure and so on? So,
yes, I can confirm, Lucy, that all our factories are working. Our people are working. We have many people in the white-collar area in the home offices working, but blue-collar workshops are all running. And we hope that this can remain like that. The only restriction we see, as Markus already said, is that we are facing more and more challenges in getting our service technicians on site of customers, because a lot of customers are not allowing any more external visitors to their sites. We are also thinking of creative solutions, sending our technicians by night when nobody is there and so on. So there is a lot of activity going on. And situation changes daily.
Thank you. And just the last question, maybe moving away a little bit from the coronavirus situation. Can you comment maybe on the latest trend you've seen in your key end markets before that actually started, and what you are seeing now in terms of level of demand from your customer? Is it do you see a lot of delays in terms of their decision? Or maybe not so much, just what you're seeing in current trading. Thank you.
Yes, I can tell you that we had quite a good start in the year 2020. So we are very optimistic that also Q1 at least will be quite a good one. But of course, as I said, the situation is very dynamic. But I have to remind you maybe what our key business at the end is. We are delivering machines where our customers are producing food and beverages. And I mean, if there is corona or not, people need to eat and drink. And as more people are staying at home, as more it might increase the demand for processed food. So if people are not going to a restaurant where you can eat fresh fish, fresh vegetables and so on, and people staying at home and eating more processed food, that might also be a positive impact on our customers. And at the end, and medium and long term, they also need to invest, therefore, in new equipment, and they need to service the machinery, they need spare parts. So I would say there is no doubt at all that our long-term trend and our market demands are intact.
Thank you very much, guys.
Thanks.
Thank you. The next question is from the line of Felicitas Bismarck. Thank you. Please ask your question.
Hello, can you hear me? Sorry.
Yes, we can hear you.
Hear me. Very good. Thank you very much. I have a couple of questions. The first one, could you give us any indication of what your underlying assumption is on like just European growth or global growth under your guidance, or is that really just the impact of people being disturbed by the supply chain, so to say?
So we said that this year it's gonna be slightly lower, our revenue compared to last year. How it's gonna be globally, we can't tell you actually. But what we expect with the coronavirus, that there will be a certain slowdown. As Stefan said, our end markets are in general intact. Nevertheless, I mean there will be some impact this year. That's why we said slightly lower. We still think that going forward in the next years, that assuming then when the coronavirus actually has come down, has settled, that we will see at least a growth of 2 to 3%, as we said on our capital markets.
So is it reasonable to assume you made like a 500 bps cut to your growth assumptions, so 2-3% normally and now 2-3% negative? Something like that?
No, we have not specified this, and as I said, slightly lower, and we are monitoring actually. We are monitoring this right now. There.
Okay.
We don't.
And on your sorry.
Good. Go ahead.
On your current trading, did I understand correctly that you haven't seen any impact in February order intake numbers from this?
No, not yet.
Okay. And then another one. Can you confirm that your debt runs on covenants that are ex-pensions and on the adjusted EBITDA after IFRS assumptions?
Say that again. What's with our covenants?
Your covenants, they run ex-pension debt, right? They are only based on your financial debt, not on the pensions.
They are only based on our financial debt, yes, not on our pensions.
Yes. Okay, and then the last questions I have, can you maybe remind us on your approved capital measures that you have from the IGM last year, and do you think it's a good idea to maybe increase those?
Actually, yes, we will do this. We're gonna come actually with the proposal with the AGM invitation out, and so you will see that everything which expires will be renewed. This will be our proposal for the AGM.
Okay, thank you.
Thanks.
Thank you. Next question is from the line of Sebastian Groh. Thank you. Please ask your question.
Yes, good afternoon. Thanks for taking my questions. The first one is around the EBITDA guidance and particularly around the bridge. You indicated in your prepared remarks that obviously you had the 40 million, give or take, which is non-recurring. So the starting point is rather 520 for the EBITDA. So my interest is focusing on what you have been assuming so far in the potential decline in service revs to just get a better sense of the overall sensitivity to those very, very high margin business contributions. And then also what have you baked in terms of the headwind from wage inflation for 2020, if I may. Then moving on to portfolio, you had the impairment charge for Pavan and following the very impairment, and your comments indicating that the top line development has been quite satisfactory. My question is, what are you doing to tackle the margin, Diane, which has been obviously in free fall since the acquisition, and that would normally suggest to me at least that we should be prepared for potentially further layoffs to come, in particular that asset. And then final one on services. You, I think, indicated in the prepared remarks that you came in rather late in the quarter with price hikes, if I understood that correctly, for business area solutions. Can you just give us a sense of the general price escalation is that you had planned for 2020 and how this is going with customers as we speak? Thank you.
Okay. Now, first one, talk about the EBITDA bridge. That was your first question. You're talking about the bridge actually from 19 to 20, or was this just in 19?
No, for the year 20, from 19 to 20, that is, yeah.
19 to 20, okay, gotcha. Okay, so, well, we thought that for 79 is the EBITDA before restructuring, and as I said in my prepared remarks, that we had special items of 41 million, We don't assume we get in 2020 another 41 million one-time effects. Of course, every year there are one-time effects, but by far we do not expect that to see that amount. Then we set 26 million euros in procurement savings, also on our capital markets day. That's also our expectation. And with these 600 FTEs, we also think that there should be a cost savings of around 25 million from that. However, I mean, on the other side, we had last year positive FX effects of 20 million euros, so you need to deduct these. We expect to see a salary increase in total of around 26 million. And then, of course, we have a corona effect, which we estimated in different scenarios, and also some additional risk buffer. And so when I take both into account, we end up here with our guidance with a midpoint of 455. If we can have all the price increases, which we usually assume, we might end up at the higher end. And if Corona is getting really worse and negotiations are getting tougher and our service business is affected, from today's point of view, this might bring us down to the lower end. It's pretty much in flux, as you can imagine. What's going to be the effect of the coronavirus?
Yeah, that makes sense. And specifically on the service element, because I think you stressed it a couple of times and in your earlier answers that you provided. Can you give us a sense to what you're planning is looking? So are we looking service revenues down this year? Would you conservatively say it's eventually only about flat, or what is your working assumption there in particular?
Well, we don't have any working assumptions here right now for the service, because we expected actually to have steady prices in our planning plus some inflation adjustments. If we can have more, we're gonna try this, of course, to increase our service prices. As I said, the Corona issue might hold us a little bit back to be able to do price increases in service this year. I think I answered your question to wage inflation. I said that was around 26 million in total. Then you said here, Pavan, that the margin needs to be improved. We fully agree to that statement. We are working on this. There have been some layoffs, also part here of the headcount 800 program, which we announced. So we'll bring some efficiency to Pavan as part of this program here.
Okay, but this is it for the time being, or can you just remind us of what is coming up then for potential further provisions that you might take for the year 2020?
Well, we're going to have some, of course, we're going to have, as announced, we're going to have some restructuring charges of around 50 to 60 million around that number. There's no such thing as something really big at Pavan. I mean, we're bringing down the number of employees there, bring more efficiency in, and it's still a workable company. We just really need to focus now on the margin, and that's what we're doing right now.
Okay, fine. Thank you.
Thank you.
Did I answer all your
questions?
Good.
Sorry. I'm just going to introduce the next question. It's from the line of Sebastian Hubert. Thank you. Please ask your question.
Yes, good afternoon. Many questions have been answered, but one is still left over. Also, maybe an update on the current situation in Germany now that schools have been closed. How really does your blue-collar workforce come to work as they need to care about kids, and how do you see this going forward? How do you manage this process, and what could we potentially see as an impact to your productivity or to your top line? Thank you.
As I already said, all our factories are running right now worldwide, so we do not expect a significant impact in the blue collar world. In the white collar world, we have a lot of people, meanwhile, in home office wherever it is possible, but we have good IT infrastructure in that aspect, and so we are very optimistic that there is also very limited impact. And as I said, the biggest challenge is how the service business develops, and of course, in a longer period of time, if we also need to install machines and equipment at customer side, it's always a question how customers are reacting, and can we bring our people in, or we also have some topics, for instance, that we cannot fly now to the US. When we have to finish projects over there, or we have to send special welders to the US, things like that. There might be an impact, but at the moment it looks still quite good. But the situation, as you know, it's extremely volatile and dynamic.
Okay, and then maybe one follow-up question also with regards to the new setup of your organization. Will we get some more additional data, such as order backlog, EBIT by division, and maybe also the share of services? That would be quite helpful.
Share of service, probably not, but we will disclose more information about the divisional structures and also numbers when we have our Capital Market Day, because as you know, we just started. We also changing our organization with 20,000 people also is not something which goes from one day to the other. So we need to have clarity about the numbers, and this will be at the middle of the year. And we have the Capital Market Day. You can expect more details.
Okay, thank you.
Thank you. Next question is from the line of Akash Gupta. Thank you. Please ask your question.
Yeah, hi, good morning, everybody. Thanks for your time. I have two questions, please. My first question is regarding your project business. Can you talk about risk of liquidity damages or penalties from customers in case if you have delays in finishing projects?
Normally we have in our contracts a force majeure clause, and everybody knows about the overall situation. So far we have not any negative impact out of that.
Thank you. And I have a follow-up on your capex and IT investments this year. Can you talk about what sort of flexibility do you have on both capex and IT investment? And if the current situation and we enter in a bigger slowdown, do you have room to delay some of these investments into next year and beyond?
We don't see this, that we have to delay any investment right now. At the end of last year, we bought the necessary SAP licenses. This year, it's going to be not that much capex because we are programming and setting up the processes for the new SAP template, and our other IT projects are actually on their way. We don't have any liquidity shortage right now. We don't see any material, as we said earlier, any material deviation here of revenue currently. So we don't see the need actually to postpone that. On the other hand, we are watching that situation, of course, closely, preserving liquidity there, but we will be actually right now executing on our IT strategy.
Thank you.
Thank you. Again, for those participants who would like to ask questions, please press star one. And our next question is from the line of Lars Brorson. Thank you. Please ask your question.
Thank you very much. Hi, Stefan. Hi, Marcus. I've got a few, if I can take them one by one. Following up on the service operations, Stefan, and the challenges of getting service technicians on site. I'd be obviously in chartered territory, but just in light of these lockdowns and broader limitation of movements, I wonder whether there's some way for you to help us understand and quantify the impact. And again, fully appreciating a fluid dynamics, but for example, if you look at say the number of service visits in Italy over the last couple of weeks, say, what does that look like relative to the same period last year?
Lars, I have to tell you that I cannot answer these detailed questions because, of course, we are installing some, or let's say many reportings about illnesses, about tested people, about home office numbers, and so on. But as I said, the situation is very dynamic, and it also can change from day to day. So far, I was also in touch with our division heads and regional heads yesterday and today. So far, it is very limited. But as I said, and also know that during the last 2 or 3 days, the measurements, the activities which were set in place from all the governance, fortunately, I have to say, got stronger because I'm fully convinced as more consequent everybody now is, as faster we are through this crisis. If we adapt and adjust all the measures step by step, it will take much longer time. So I think the companies are doing a very good job handling the case very, very consequently. If public would do it in the same way, I think we would have been through much faster. If you look now around, if sun is shining, people are still sitting in cafes and still hanging around in restaurants. So and this is not good, and it also makes no sense that we send people to home office and that our service technician cannot access sites while public is still dancing. So we hope that this will be changed quickly, because this is the only way how we can get rid of the whole corona disaster in a very short time.
Understood, Stefan. I'm going to try another maybe slightly unfair question around the COVID-19 impact on your guidance. And I will applaud you for at least attempting to come up with some guidance most other industrial companies don't. But what you're doing in your sensitivity table in page 153 in the annual report, where you try to gauge specific economic risks and the associated EBITDA impact, you're obviously categorizing COVID-19 as a quote-unquote moderate risk, and I pencil that in to be a 20 to 70 million impact. I would have thought it needs to sit right up in the right-hand corner of your matrix, i.e. at least 120 million impact for 2020. Maybe to ask a little bit differently, if you think back 2 months ago, as you started to think about the 2020 guidance, EBITDA guidance that is, can you give us some sense for what you were thinking pre-COVID-19?
So, this is Markus. Hi, Lars. Let me answer this question. Before COVID-19, of course, we would have expected that revenue would be up, and we would have higher guidance, of course, higher range for EBITDA and for ROCE. Well, take a look actually here of the what's the result, what's the effect. So if we take what you suggested on the upper right corner, I mean the financial here would be above 120 million, or significant would be at least 70 to 120 million when you look here at page 154 at our risk matrix, and we don't see this at this point in time. We see that there probably will be an effect, and that's why we chose the range with a midpoint of 455 million, and that's why we actually have it classified as we did here. But as I said earlier, we are monitoring the situation closely, and let's see how businesses around the world will be affected.
Understood. If I can try a third and final one, please, just around working capital. And you've done well, I think, in Q4 and 2019 to manage working capital as you laid out with your corporate-wide program in August last year. Specifically, if I can just ask to some of the smaller end markets like oil, gas, and marine and shipping, although they're very small for you, but are you seeing stress among customers in some of these, and are you doing anything differently from a working capital standpoint, i.e. in terms of collecting receivables or otherwise?
So far, we have not seen anything like that, but it takes a bit more time actually to come into a liquidity situation unless they have a product which they sell cash and carry, which is not the case here with oil and gas and shipping there. So there might be some lag, but so far we have not seen any constraints there. But as I said, we're monitoring also these customers very closely and see if there's going to be some effect. I would not exclude that there will be some effect in the future. Simply, we have not seen any yet.
Understood. Thank you.
Thanks.
Thank you. The last question is from the line of Felicitas Bismarck. Please ask your question.
Thank you very much. I have two more questions, please. The first one is it fair to assume that you're postponing your divestments that you have announced just because pricing you could get right now and if people who want to buy this right now is more difficult to find? And the second question would be, have you baked into your assumption any recovery in this, like in Q3 or Q4, or is it, do you assume the impact is going to be negative for the entire year coming from COVID? Thank you.
We are still going forward with our divestments. However, also there, used the word we are monitoring the situation closely. We are monitoring the situation closely. We have got feedback from private equity companies actually that they are monitoring right now full focus on their portfolio companies. So whenever there's private equity involved, we need to see actually if they are still in acquisition mode. So far, we are pursuing our divestments as planned. But with the caveat I just said, let's see, especially PE, if what they're doing going forward, if they see this as an opportunity, this situation, or if they have their hands full monitoring their subsidiary. Recovery, no, we have not baked in any recovery yet. But as I said, there is a range. So if there's recovery, we can have price increases. Our range goes up to like 480. If it's getting worse, well, our range is currently going down to like 430. That's where we are. I mean, that's the best I can do. That's the best we can do right now.
Do you have a similar range for the growth as well?
No, we don't have a similar range for the growth. As you said, slightly, and this is 0 to 5%. 0 to 5%. In that sense, we have a range. But let's see if we're going to be at the lower end at 0 or at the higher end at 5. We don't know yet either.
Okay. Thank you very much.
There are no further questions. Please continue.
Okay, if there are no further questions, let me make some final remarks. I think what is important to mention that 2019 was a strong year for GEA, where we really could change many things, which put a lot of stress to the GEA organization during the last years. We established a completely new organization. We changed a lot of people in the management team. We are really now in a setup which allows us to steer and control the company much better. And above all, I have to say this, if there is corona or not, people need to eat and drink, and this is our business. We are producing the machineries, the processes, the equipment for our customers who are producing food and beverages and pharmaceuticals. So the long-term trend for our industry is brilliant, I would say, and that's why we are in the medium to long term still very optimistic. We will use the time to do our homeworks. We now have to manage the corona crisis. This is what we do. We will protect our people. We will do everything to keep our good and qualified people, and at the same time, our intention to limit, of course, the negative impact on our organization. But medium to long term, this is an excellent market in which we are in, and therefore we remain very optimistic.
Yeah, that concludes our call today. Thank you very much for participating. And if you have further questions, then please come back to the IR team. Thank you very much and talk to you soon. Bye-bye.
So that does conclude our conference for today. Thank you all for participating. You may all disconnect.
Kommt da nochmal zurück?